Hello and welcome to this session in which we will discuss deduction of losses for business entities. In the prior session, we looked at how income is taxed for business entities. So if you have income, that's great. Let's have the income and let's tax it. We're happy to have the income. How about if we have losses? Well, the way losses are treated also matters because the way we treat losses for C corporation is different than tax flow entities like an S corporation or a partnership or Schedule C. Therefore, we need to know the rules for losses when it comes to business entities. Now, a prior knowledge for this session will be knowing what's NOL, not operating rules, and also knowing how to compute the basis. That's very important. So in this session, what we'll try to do is explain if somebody walked into your office saying, okay, I have this business, I'm going to be incurring losses. What will you advise me to do? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Well, when someone walks into your office, they might be self-employed 100%. It means that's all what they do. They have their own business. Or they might have their own business and they have a W-2 on the side. In other words, they are still working for a company and they have their own business. So they are running a business. And sometimes they might be by themselves. Sometimes they might be with a partner. Now, in tax, we don't hate losses too much. I mean, yeah, losses are no good. We want income. But also losses can reduce our taxable income. And guess what you have to do? If you can reduce your taxable income, that's good because you could reduce your taxes. If you have to pay for something, if you have to incur an expense to grow your business, well, you would rather not to. You would rather, just have the income without the expense, but it's necessary to incur losses, to incur expenses. Well, that's fine. If we're going to incur the losses, it's not a big deal. We're growing our business. But the good thing is if we can take this loss, use it to reduce our taxable income. Specifically, if we could reduce other taxable income, especially if we have a W-2. And that's why we say we kind of like losses. It's not that bad if the losses are helping us to grow our business. So the process to deduct the losses does what? It's a complex process. Why? Because we have various restrictions depending on the type of the entity. And this is what we will discuss. One of the restrictions is net operating loss. There are certain rules for net operating losses. For example, corporation, they can only deduct up to 80% of their taxable income using any net operating losses. It means there's a cap, there's a limit on how much you can reduce your taxable income by in a particular year. Also, we have other hurdles that we need to be familiar with. Hurdles are obstacles, things that does not allow you to deduct your losses. So we need to know what those hurdles are and how do they work from one business entity to another. Let's start to discuss the hurdles. Hurdles to do what? Obstacles to deduct losses. Specifically, we're going to have 4 hurdles in total. And those hurdles, 2 are entity level hurdles and 2 are owners or investor hurdle. There are tax basis and risk limitation that apply on the entity level. What's the tax basis? It means, do you have enough money invested? It doesn't have to be money, but mainly, what are you invested in the business? Refer to the amount the investment owner has in the business. Think about how much cash you invested in that business, because that's going to limit the loss deduction. If you don't have any money invested, well, then what are you going to deduct? Also, you have to know the at-risk amount. What is the at-risk amount? There are different rules for the at-risk amount. In other words, how much are you at risk in this business? Because you could only also deduct up to the amount at risk you are for that business. And those are entity level hurdle on the corporate level. Then we have 2 other hurdles on the individual level. Then you have to look at, are you actively participating in the business? In other words, Are you a passive? And if you're a passive, it means you are not actively participating. Then you do what? Then you are considered passive. And because you are passive, you can only deduct passive losses against passive income. So also you have that limit. And there's at the end an excess business loss limitation. The government says you can deduct your losses up to an amount. That's another limitation. So the passive activity loss rule limit the deduction of losses from passive activities. What are passive activities? Activities in which the taxpayer does not actively or materially participate. In other words, if you don't participate, if you are not running the company, if you are not actively participating, then you can only deduct those losses against other passive income. Well, if you don't have passive income, then you cannot use those passive losses, at least for now. And the excess business loss limitation, simply the government says you are up to a point, then above that point you can no longer deduct this. You can no longer deduct losses. So restrict the amount of business losses that can exceed business income, limiting the loss that can be used to offset other non-business income. Up to a point, and they stop you. So why do government have these limitations? And we talked about this when we talked about NOL. These limitations make sure that only genuine losses up to a certain threshold, so the losses has to be real losses from money that you invested, you are working at the company, up to a certain amount, meeting certain conditions. So you cannot just say, I'm going to run a business, generate losses, take my losses, and offset other income with it. Then you never pay taxes. That's why we have those limitations. Now, when it comes to flow-through entities, choosing the right business structure can affect those limitations. What does that mean? Flow-through entities like a partnership and S corporation allow the losses to pass to the owners. Well, if they can be passed to the owners, they can offset other income. If they can offset other income, then they give us a tax advantage. They give us tax advantage. It means what? It means you can use them. This feature is beneficial for new businesses which often face initial losses. Remember, you could still be working for a company and you're starting a business. You still have a W-2 income. You're still getting paid from a company, but you have a business on the side. And you have this business, it might incur losses at the beginning. Well, if that's the case, what should you do? Have an S corporation or a partnership. It's a flow-through entity because the losses goes to you. And because it goes to you and you have other income, you can use it. So in a flow-through entity, if the owner has sufficient investment, which is they have enough tax basis in the business, and they actively participate, that's even better. They can use the business losses to reduce their personal tax liability immediately. And if they actively participate, there's no limitation for the passive activity rule because you're actively participating. So there's an immediate benefit to having an S corporation or a partnership if you're going to be incurring losses and what? And you have other income that you can offset those losses with. Now, if you operate as a C corporation under those scenarios, well, you could only offset income from the C corporation in the future when you have other income. And you are limited to 80% of your future income because you could not reduce your income to zero with the new NOL rules for corporation. So in the future, if you have $100,000 of taxable income, you can only offset $80,000 of that income. You still have $20,000 of taxable income. You might have $1 million in NOL. Although you have $1 million in NOL, you are limited to 80% of your taxable income in future years. You can use it, but you are limited. So that's why if you have losses and you have the losses and you have other income, yeah, well, let's do an S corporation. If one individual, LLC S corporation. If more than one individual, let's form a partnership. Now, we have to understand also within flow-through entities, because we have more than one option. We could have a partnership, we can have an S corporation. You have to know the rules within those flow-through entities. So the capacity to deduct might differ between owners of partnership and S corporation because how the bases are computed. Remember, one of the hurdles is basis. For example, a partnership, the basis and the partnership include the share of the entity's debt. In other words, when we have more debt, the tax bases increase. What does that mean? If the tax bases increase, this gives us more capacity to deduct losses. This is in contrast to an S corporation. S corporation basis does not include the corporate debt. So this is why you also have to dive deeper into flow-through entities. They're not all the same, because you cannot use the debt of the corporation to increase your basis. You are limiting your basis, which in turn limiting your losses. So flow-through entities, partnership, S corporation, offer a strategic advantage to owners looking to use those losses to offset personal income, especially early on in the life of the business, because this structure can provide more favorable conditions. You can deduct the losses now. In comparison, if you incorporate as a C, or you're running as a C corporation, then the losses can only be offset against C corporation taxable income, and you are limited, and you have to carry it forward depending which year is the NOL. We're assuming now the rules are only carried forward. Let's take a look at an example to see how these rules are applied. Julia and Alex are launching a tax startup together, 50-50 partners. They both invested a significant amount of money in the company. It means they have a significant basis in the company, tax basis in the company, ensuring they have enough basis, which is good. They plan to be deeply involved. It means they are active partners in day-to-day operation. What does that mean? It means forget about the PAL rules. We don't have a passive activity loss rule. We don't have to worry about this. In the nature of their business, they have to be involved, which is good. Now, they intend to reinvest any earning back in the business to fuel growth and don't expect any personal distribution or salaries. In other words, they're not reducing their basis through distributions until the startup is stable and making profit. Both have additional income streams and fall into the upper middle tax bracket, which is good. They have other income from other sources. It means they might still have work for other companies, or they might be doing some consulting work on the side. Determining the most tax efficient structure for their situation. So in this situation, what would you recommend? Would you recommend a C corporation? Would you recommend an S corporation? Would you recommend a partnership? Well, let's take a look at the solution. Well, starting with C, organizing the business of a C corporation means that any NOL generated in the early years can only be utilized within the company. So the first thing, what do we know about C corporation? Losses from C corporation can only be applied to C corporation. Either carried back if applicable, we're going to assume it's not applicable, they're new, or carried forward, which is carried forward to future taxable year. It means you're going to get benefit, but that benefit in the future. It means there's a time value you're going to be losing now. Also, as we mentioned about C corporation, you could only offset up to 80% of your taxable income. So you're delaying that benefit, and when you take it, you're limited. On the other hand, forming a business as an LLC and treated it as a partnership or an S corporation allowed the losses to do what? Flow directly to Julia and Alex. And this enabled them to do what? Enabled them to apply the losses against other sources of income. Remember what I told you? They have other income. They still do consulting work. They might work part-time for another company. And this is going to give them immediate tax relief. Given their significant initial investment, it means they have enough basis. Julia have enough basis in the ownership interest, which facilitate the utilization of the losses. And if they are working and they invested, they are at risk. Since they are both active in the business, they would not also have to be constrained by the PAL limitation. So in this scenario, an LLC treated as a partnership will offer more flexibility than an S corporation, especially if they're going to be incurring debt down the road, because the debt will allow them to increase their basis, which is good, in contrast to an S corporation. So partnership is good. That's the best way, that's the best advice you can give them. Let's take a look. Now bear in mind, we are only looking from a loss perspective. There are other factors, but we're only looking at one angle. So the question is about only loss. There might be other consideration you want to look into in the real world, but this is not what we are doing. We're looking at how losses, what's the most advantageous way to operate a business given you have losses. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following correctly describe the difference in how basis is calculated for owners in a partnership versus an S corporation? So there's one statement here, and it correctly describes the difference in computing the basis for a partnership versus S corporation. Both partnership and S corporation allow basis to include the owner's shares of entity debt. Is that correct? Do both form of entities allow you to include the entity's debt in your basis? And the answer is no. The answer is no. S corporation don't allow you because the debt is accounted for separately. Therefore, A is out. Only S corporation allow the owner's share of entity's debt to increase their basis. I just told you. We eliminated A because we don't include the entity debt in the basis. That's out. Only partnerships allow the owner's shares of entity debt to increase the basis. That's a yes. But let's look at D. Neither partnership nor S corporation consider the owner's shares of entity debt in computing the basis. No, partnership allow you to increase your basis using the debt. Now you need to know the specific rules, and this is why you want to go to the partnership basis and just make sure you are familiar with the basis. And why is that important? Because more basis allow you to deduct more of the losses. Take advantage of that. What should you do now? You're going to go to Farhat Lectures, look at additional MCQs that's going to help you, whether you're studying for your CPA exam, enrolled agent, an income tax course, or any other accounting certification. Invest in yourself. Good luck, study hard, and of course, stay safe.